I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. We're doing another coronavirus themed roundtable. I'm joined today by John Yesford, who writes his PendragonY, a contributing author to High Dividend Opportunities, a leading service for income investors and retirees focused on high yield opportunities. So, John, good morning. How are you?
Pretty good. How are you, Daniel?
I'm doing well. I'm doing well.
That's
So,
good.
we're going to talk about BDCs today, business development companies, corporations. But the place I wanted to start is something we emailed about. And obviously, you're part of High Dividend Opportunities, leading service. And you talked about how you and the group in general is focused on income and income growth over total return. And I wanted to unpack that because I know it's not uncommon to focus on that, but it's also not obvious. So why is that your focus in a time like this?
Well, there's a lot of ways to make money in the stock market. Me, I like to focus on something that I can actually predict. And particularly in the short term, stock prices aren't really very predictable. They go all over the place. And as we saw last month, and even to some extent this month, they can plunge out of nowhere. You know, something bad happens and boom. Whereas with dividends, they're far more predictable. You can look at the metrics of the company. You can see how much cash they're earning. You can see what their sales are. And from that, you can get a good idea of where the dividends are going to go. The other thing is dividends are basically determined by both how the company is operating and the board of directors, which is basically a handful of people. You can look at it for share prices. They too are driven by these same metrics that drive dividends, but it's thousands, tens of thousands, even millions of people that are making the decision about where the share price goes. So predicting where all those guys are going to go is a lot harder than the half a dozen to a couple of dozen people on the board of directors and what they're going to do. And the board of directors are going to almost always make far more logical decisions than the market is. The market panics. A saying that I like is that one thing you can depend on the market is that it'll always overreact.
Right.
Good news will send stock down, stock prices up far more than they should, and bad news will knock share prices down far more than they should. And then the littlest bit of, once you knock them down, then the littlest bit of information will send them soaring again. So that kind of gyration tends to make it very hard to plan. The last thing you want to do is be in a position where you need cash and the market's decided that, hey, your portfolio is down 30%. So go ahead, sell. Whereas with dividends, that money's coming in, no matter what the price of the stock is. It gives me a much more predictable and reliable stream of income that you don't necessarily get from relying on capital gains. Same
So,
token, it's a bit less, but it's more reliable. So I like the predictability.
well, and so I suppose you talked about income and income growth when we were emailing, and income growth usually, as you said, is driven by the same metrics that drive share prices in the long term. The market's a weighing machine. Eventually, earnings, cash flow, etc., is what moves stock prices higher. And so you could also argue that it's a simpler way to focus on that. But my
Yes.
question to you is that all holds except when a dividend gets cut or frozen or whatever else. So what are you doing? There's some sectors, for example, that are getting hit. Energy, obviously, but even mortgage REITs and what's going on there or whatever. So what are you doing to try to manage the risk of a dividend cut or a dividend? I saw today Southwest Airlines suspended their repurchases dividend and they raised shares today. So
Okay. Yeah. Airlines are going to be suspending dividends just because they have to. They're so cash flow poor right now that they need to conserve cash. So they're not going to be paying dividends. I would.
right. But
surprised that Southwest cut it. Basically, well, one of the things that we look at the liquidity of the company um, to see if they have plenty of cash to continue paying the dividends, and see how the current operations might be impacted and reduce their cash flow. One company that we really like, EPR Properties. They invest in movie theater. They rent out basically movie theaters, and their other big client is Topgolf. Both of those, all those things are closed right now. But they also have in cash that they're sitting on over a year's worth of revenue in cash. So they can continue paying their dividend. They can buy up new buildings and properties at low prices because everybody's all freaked that nobody's going to go to the movies again, which they will. In 6 months, people will be packed into the movie theaters. The other thing that we do is we've started moving up the capital stack by investing in preferred stocks, baby bonds, and even regular bonds. A couple of weeks ago in particular, there was a big, huge search for liquidity, and people were just selling everything that wasn't nailed down. And so, we managed to alert to our members a bunch of stocks, preferred shares, and baby bonds that were just selling at ridiculously low prices. Now we're only at absurd level low prices.
right.
A couple of weeks ago, it was just ludicrous level of stuff.
Right. I was looking at the last interview I did was with somebody focused on high yield debt specifically, and we were talking about that, and I looked at some of the preferred shares and even baby bonds trading at 50% of par that have, like a lot of the market, have come back up to about 75% of par or 80% of where they were before. But yeah, there is that overreaction, underreaction cycle there, isn't there?
Yeah, but I mean, that's basically what you keep looking at the same things you do. You look at, what are their prospects for generating income in the company, in their operations, and how much cash and whatever, and how well covered is the dividend. And
with a stock like EPR or a REIT, and it's, as you said, exposed to social activity essentially in groups, and so that's obviously, like airlines, in the spotlight right now. You're counting on the dependable income, but do you have a stance on, like, what do you think of the argument that maybe it would be better to not pay a dividend and conserve cash to get there? And if they've already done something, please correct me.
EPR is still paying their dividend. There is definitely, we have looked at holding some companies that have suspended their dividend because we think and that right now the price is just absurdly low. So we realize that we're going to take in the short term maybe a little bit of a hit to income, but down the road they'll come back and we'll have them at a really great price, generating lots of cash for us. IVR is a ticker that comes to mind. They suspended their dividend on the common and the preferred shares, and recommended people pick up the preferred shares. And I believe that one has actually already resumed paying their dividends. They basically suspended them for about a week. So we basically scooped them up at like ludicrously low prices and now get a nice dividend off of them.
So that's an example of a mortgage REIT. I don't remember the full name of the company, but
yeah, Invesco or something. Yeah, I remember
thought it was
a lot better than full names.
Yeah. So we were going to talk about BDCs, and what I think is interesting. First of all, they're a source of there are quite a few baby bonds from the BDC sector, so exchange traded bonds. But also, what's interesting to me about BDCs, I used to follow it quite closely. I used to have positions in a couple of them. They're really exposed to small businesses, which would seem, especially in the spotlight, and maybe not all of them, but the ones I'm familiar with, exposed to small businesses, so they're in the spotlight of or under the glare of the shutdown period right now. And there's always been the case that the net asset value is a little bit opaque because you're counting on the company to value the portfolio correctly. So how do you think about
Right.
the sector in this climate?
We like BDCs. We have, well, we had 4 we were recommending to our members. Now we're down to 3. We decided one of them was a little bit too precarious. But what we look at is we look at how much cash and cash flow do they have and what kind of liquidity. So that's what we focused on. What we really like is New Tech Business Services. What they make a lot of their money off of is basically giving out small business administration loans, which the stimulus packages have dumped a whole bunch of money on. So just in April, they've lined up about over 750 million in those loans, which they make a lot of money off of. What they end up doing is they get the money from the SBA, they make the loan, then they sell the loan, then they sell the guaranteed portion of the loan from anywhere from 106 to 120% of the face value. And then basically they service the remaining portion, and that's where basically their capital and risk is. With the stimulus packages that have gone out, SBA loans now are guaranteed 100%. So that's 750 million that they just basically turned around into a big fat profit.
So
So we really like them.
they essentially are a pass through for that $750 million that they pass along to businesses. They then farm out the loan so that it's not a balance sheet risk for them, and they just have to deal with whatever servicing, which is all margin, is how you're describing it. Is that right?
Pretty much, yeah. So I mean, they have other business lines that they do because they're kind of a unique in the BDC realm in that they own and control a bunch of companies that provide services to all their other portfolio companies. Mm. So to some extent, some of that business might be negatively impacted because if you're not doing any business, you're not using any services. But one of the things that they do provide for their portfolio companies is they do provide network services and internet access. So with people working at home, that should probably continue to be paid. But again, the SBA loans is like the biggest portion of their revenue, and they basically just get a nice big check.
It's interesting. I didn't think about that part of the process there. And those are are the SBA loans the same as the PPP loans as far as just to maintain payroll? Because there's the aspect of the CARES Act where you're just getting money essentially to keep people on staff. Are these the same sorts of loans, or are they?
They, I believe, are doing PPP loans as well, but this is an existing loan program that basically the Feds just dumped a bunch of more money into.
Got it. Okay.
To keep small businesses afloat, help keep small businesses afloat.
Got it. Okay. So you mentioned New Tech. Any other BDCs you want to discuss?
Well, we also like Ares Capital.
Okay.
ARCC. We've looked at them, and they've got enough cash and cash flow that they should be fine. They made it through the Great Recession. They had about a 20% dividend cut. They made up within about a year. So we're thinking they should do fine. There might be a cut, but we figure that the income will come back. They've navigated this. They've been around. Their management company, because they're externally managed, has been around for 30 years or something like that. So they've gone through multiple recessions. So we're not particularly worried about them, and they have the liquidity. One I personally like is Maine. that's like, I've written on Maine dozens of times. It's the first BDC I ever got involved in. It's one of the best run BDCs out there, in my opinion. For HDO, it's until very recently, the yield's been too low. We like to, in HDO, we pretty much don't recommend stocks with yield below 6%.
Okay.
And until recently, Maine didn't quite hit that. Now it's at 10%, and honestly, that's a steal. And the only thing that dividend hit we expect from Maine is that they're probably their June special dividend probably won't happen.
Okay.
Because that usually comes from basically realized capital gains. They fund that from for the most part. So we're thinking that that's probably not going to happen. And given that they usually announce right around in now and haven't said anything about it, we figure that that's because they're not going to give it.
With BDCs, it seems I was trying to think about this before the call, and then as you're listening to you as well, there's not a ton of cost in the structure, right? There's just whatever management fees and then whatever interest they're paying for their own debt, right?
Right. Then they have only a few employees for the most part.
Right. So, I'm just thinking about valuation down the line. If New Tech is an interesting case because, as you said, they're really exposed to the SBA loans and maybe those, and then I don't know the full balance sheet story, but you're saying they're farming those loans out. But let's say that portfolio companies struggle. Is that a risk at all with any of these companies where let's say portfolio companies struggle, net asset value gets dropped, and then that has effects on whether it's maintaining the dividend because I don't know. Is that something that?
Well, that's why in part that's one of the reasons why we like ARCC so much. They got lucky. They had just sold off a big investment just before everything crashed.
Better lucky than good.
Pile of cash all sitting and ready. And one of the things that BDCs do that are different from CES is BDCs actually take an active role in helping their portfolio companies operate and manage. So they give guidance, they find them, if they need some product, they help they help their companies, and they'll help their company find it. So the experience that these companies have had working through bad times before are a plus for them. Again, and two, that's why we looked at liquidity. Some portfolio company gets into trouble, we're looking for the BDC to come use some of their cash to help prop them up and get them over the bad part.
Got it.
And that's why, we did I'm not sure if this is yet gone out to the public site yet, but we did for our members, we did analyze liquidity levels of all our BDCs we recommended. And that's why Monroe Capital was our fourth one, and we decided to move that from basically a top buy to, okay, hold that, and as soon as the price comes up a bit, sell it.
More about, yeah.
Mainly because they had the lowest amount of available liquidity. And a number of these companies also, what they did, they drew down on their lines of credit. A lot of people all got all nervous when companies drew on their lines of credit, but it was actually a smart move on anybody's management's part because they're counting on that money in the line of credit being there when they need it. But given current circumstances, the bank might decide, you know what, your line of credit's cut in half.
Right.
So if they take the money and have it all in cash, the bank can't say, no, you can't have that.
Yeah,
so
foresight in a situation like this.
Yeah, and that's and that's one of the things that we like to see is we like to see management being proactive for stuff. If we can see that there might be a problem, we expect management to already have been acting on it.
Right. Good point. It's what's interesting to me about BDCs is that they're sort of they're your general investing process on a micro level. You know what I mean? Because you're investing in companies that are then investing on, and so you get a different view of the economy. You get a different view of the world, and you try to. You're. It's very easy to put yourself in the shoes of the management team because that's sort of what you're doing yourself as an investor is
Right.
deciding where to allocate your money.
Yes, yes. And that's one of the things why for both CEFs and BDCs, a lot of people are like, oh, I only buy if they're trading below NAV. And it's like, I don't see it that way. I see that management, especially in BDCs, should be adding something. So I, I want to own them when they're trading above NAV. I certainly don't mind buying them if they dip below NAV.
Right.
But it's kind of like, the ideal BDC for me is like, every time I have cash and I want to buy it, the share price drops below NAV and I buy some.
Right. Right.
But otherwise it's trading above NAV. Because one of the things that Maine does that makes it that helps make its performance so outstanding is that since it's trading at a premium to NAV, it's regularly selling more shares to buy more assets than the underlying shares currently are supported by. So it has this steadily increasing NAV, which is fairly unique. Well, I won't say unique. It's rare in BDCs because basically BDCs, their biggest investments are loans, which get paid off.
Right.
So they're constantly fighting to maintain their NAV, whereas Maine, it's almost a straight line up.
Right.
In fact, and every time I write an article about Maine, they have a slide that in their presentation, and I basically give it, and then you see that there's the upward trending NAV, there's the upward trending net investment income. It's like this is why you buy Maine because it does this all the time.
Right. I get that's why they are the most popular. I would say BDC at least among Seeking Alpha. It seems the leading company in the sector.
Yeah, I don't know. Some people seem to like Prospect Capital a lot for some reason.
I would say Prospect Capital is the more controversial
Yeah.
BDC based on observations over the years. Never had a position in either of those two, but Prospects has always been in the crosshairs of vigorous discussion on the site.
Yes. Well, I've written. It's one of the few companies that I've regularly written articles about why you shouldn't buy it. Because for the most part, what I found on Seeking Alpha is what tends to be most popular is articles of telling people why they should buy a company.
Mm-hmm.
Articles telling people why they shouldn't don't be very popular, except for Prospect Capital.
Yeah, yeah. It's been a while since I've looked, but those comment streams tend to be pretty. A lot of personal insights and grievances or successes are shared in the.
Yeah, I get people that are like, "Oh, this is a great company. What are you talking about?" To, "Oh, yeah, right on. This is a horrible company that the managers are all thieves."
Yeah, yeah. It's an interesting company, but okay. Well, John, thank you so much for your time today. That again, I was speaking with John Yesford, who writes his PendragonY on SeekingAlpha.com. He's a contributing author to High Dividend Opportunities, a leading service for income investors and retirees. You can find the service on his profile page or by going to SeekingAlpha.com/marketplace. John, any disclosures before we wrap up? Any positions in any of the companies mentioned?
I own all the companies mentioned except for Prospect Capital.
Okay. Fair enough. Okay. Very good.
Okay, sure.
All right. Thank you so much, John.
Well, thank you.